Okay, let's move on to the income statement. The income statement is somewhat similar to the balance sheet, but not exactly. One of the ways it's different is that the income statement measures financial performance over a specific period of time. Now, the balance sheet is on one specific day. It will have a date on it. December 31st, 2000, whatever, is when they valued the assets, liabilities, and the equity, and it'll be just that snapshot in time. The income statement will be over a period of time. What did we do in operations over this period of time? Could be a month, could be a quarter, could be a year. Those are the common ways to measure it. And so when we think of an income statement, it's the ongoing operations of the firm, what's going on. And so we can look at the general definition here. Revenue minus expenses equal income. So what we're trying to accomplish here is to say how much money came in, how much money went out, and what's left over for us. And so you can relate to this, of course, because every month you have a paycheck coming in and you have expenses going out and you want to know what's left over. Hopefully your cash flow is positive. It doesn't have to be. You can have losing quarters or losing months and so on, personally as well as the corporations can. But that's basically what it is. Think of the income statement as your checkbook and think of your balance sheet as your net worth. How many assets do you have and how much do you owe on them? What's left over is your equity, which would be your net worth. So you can apply this to your own personal life very easily too. Beyond that, well, let's look at an income statement here. This is in millions, so the 2,262 under operating revenues is actually 2.2 billion. So we have 2.2 billion in operating revenues. Another term for that, of course, is sales. We have cost of goods sold, or COGS, for 1.6 million. Selling general administrative expenses is 327 million. Depreciation is 190 for operating income of 190. So we've taken how much money's come in, the sales number, and we started subtracting things off of it. Now we get past that and we start thinking about other income. Maybe we have a subsidiary that's thrown off some profit to us, and so we would have other income coming in. In this case, it's $29 million. So our earnings before interest and taxes are $219 million. Earnings before interest and taxes is commonly abbreviated as EBIT, E-B-I-T, EBIT. And so it's very common in finance to talk about EBIT. What is the EBIT of a firm, etc., because the interest and the taxes are not necessarily relative to the operations of the firm. They can vary quite a bit firm to firm, but the operations of the firm are encapsulated in the EBIT number, how profitable the firm is. But nevertheless, we do have to get through earnings and taxes, so of course they are next. So we have EBIT of 219. We paid 49 in interest. We can deduct that from our taxes, so we get rid of that. So we've got 170, which is our pre-tax income, or EBT, earnings before tax. And then of course we got to pay our taxes. In this case, we paid for 84 million in taxes, and those are broken into two different categories. 71 million we have paid current, so we're going to be paying those, and 13 million is deferred. So the 13 million is deferred. We will be paying those in the future. The net income, therefore, is the 170 minus 84 gives us 86 million in net income, and we've broken that into two pieces. Our net income can either stay in the firm, so it can help the firm grow, or it can be handed off to shareholders through the form of dividends. Now, what's interesting here, we mentioned earlier, is that corporations are double taxed. And you can see that this is after-tax income we're sending out to shareholders. We've already paid our 84 million in taxes, and now we take this 43 million that we're going to, of our earnings and net income, and we're going to send that out to dividend holders, and the dividend holders are going to pay taxes again on it. Now, this depends on your tax bracket and so on. You may not have to pay taxes if you have very low income, but if you have regular amounts of income, you know, two people working or even one person working, you're going to be paying taxes on it. Now, it's a lower rate than your income tax. It's a capital gains tax rate or a dividend tax rate here in the United States. And every other country will be a little bit different in how they handle this, but you're going to pay taxes again on it. So as an owner of a public corporation or a C Corp, whether it's public or private, the shareholder that receives the dividend is getting after-tax money that they again have to pay taxes on. That's why we consider C Corp double taxation. And so a lot of people argue that that's not fair and that's not the way it should be, but it is the way it is, so we need to account for that. If we go past this, There's another term of vernacular here I want to discuss with you, which is net income. And net income is the bottom line. The bottom line is net income. We call it the bottom line commonly. So, sales, the first number here, it says total operating revenues. We call that sales or revenues quite often. COGS, cost of goods sold, we use that as a shortcut. EBIT is earnings before interest and taxes. We use that quite often. And pre-tax income is EBT. And then, of course, net income is the bottom line. It's profitability. It's your profits for the term, whatever time period it is. So don't get too confused on that. I tried to give you insight into the terms. For example, my favorite is the bond market, the debt market, and the credit market are all the same thing. And you could have people refer to them as different things, as if they were different things, in the same sentence. The bond market did well today. Boy, that credit market was great. And they mean the same thing, but it's just the way they talk. So learning the vocabulary, if you're a new student of finance, is going to be part of it. So we'll try to throw those in as best we can. So this is an overview of the income statement. Now let's do some analysis on it in the next video.